We trade kind of little change, really, I guess, against the close yesterday on the oil price. But what a week it has been. We're up at 51.12 on WTI, 53.85 on Brent. A lot of market repositioning around the deal that we saw agreed in Vienna this week.
Exactly. You don't see a big market like oil move up 10% intraday that often. I've seen it 3 or 4 times in the last years. And this is a kind of repositioning going on in the market because the tail risk of investors have been that there is actually no deal. And that there was a deal surprised market participants as the decision in Algiers in September.
So I've got an interesting chart here. This is BTV hashtag 623, which is all about backwardation. So this is looking at the December 2017 contract and the December 2018 contract and talking about what that tells us about supply constraints in the future. You can see that we've gone back into so-called backwardation on the oil market, which apparently suggests concerns around future supply constraints. Is that the big concern for markets? Because other people suggest to me, actually, the US producers are just going to come back into the market, so there won't be supply constraints.
I think there are 2 points I would like to emphasize on, like 2 sides of the medal here. First is a backwardation, normally is a sign for scarcity in the market. So, as you said, worries about future supply, that's true, because when you look at EIA forecasts for oil, we have like roughly 1 million barrels a day oversupply in the market. So with a decision to cut 1.2, 1.5 million starting in January, this oversupply is vanished. So therefore the market is in balance faster than expected. So this is the good thing in the market. The second thing I would like to say, remember the drought we've seen in Australia a couple of years ago and the effect on prices on wheat and corn. Wheat and corn shot up into backwardation after they rallied 20 to 30%. And this attracted also investors, but it attracted investors who are interested in backwardation only and not caring about fundamentals in the markets. I mean, you're not buying into something that's just double it in price, right?
So this is all about what hedge funds are doing rather than the fundamentals. Is that what you're saying?
No, it's not the bad hedge fund game. It's just a matter of financial speculators in general, but also on financial markets because it's the term structure of the oil market. And now the lucky guys are, for example, the US shale industry who can hedge at this level for next 3-6 months out, and also Russia or like OPEC members who will now profit from the high prices.
Looking at more broadly the commodities market, you think that we are at the start of a new commodity bull market. Is this based on the US growth story, firmness in the Chinese story? What's this based on for you?
Actually, we had this thesis on since the beginning of the year, since April. We came out with research on that, and we emphasized this now in our capital market outlook for next year as well, looking at the Bloomberg Commodity Index as like a gatekeeper for like 22 commodities. Because from the fundamental side, we are in bad shape. Lots of commodities still in oversupply, but this oversupply to regard to the beginning of the year has been reduced already. So it's moving to a better side, moving to scarcity. And from a technical point of view, we've seen like a bottom building in January, February, and the Bloomberg Commodity Index for the first time a long time ago shot through its 200-day moving average line, creating a positive bull signal in April. So therefore, commodities without the Trump trade, moved into positive technical territory and also with a positive fundamental outlook.
And what does Trump do for commodities?
Putting a lot of acceleration in the short term. I think the move we've seen, for example, in copper, moving up from 4,500 up to 6 in an instant in terms of future infrastructure spending programs to come, to be developed in future, is a bit too much in the short term. Also the same move on the other side in gold. We've seen lots of people hedging against this result of US election because they said, careful, I don't know what's going to happen. Gold shot up $50 after the election, then dropped down, and stop losses were traded at 1,200. So I think the contradiction between base metals and precious metals in the moment is a bit too much, and this Trump trade is reverted.
Yeah, just checking in on the gold price and where we are right now on spot gold. We're at 1,175 a troy ounce. I mean, but gold doesn't like inflation, does it? So where do you think these precious metals will head if we see the Trump trade? Interesting.
I think all commodities like inflation because commodities in general is a kind of inflation hedge, partly. Gold as well. Oil is a better inflation hedge, that is true. So it is not only nominal interest rate, it's inflation, so it's real interest rate. And the market is now pricing in a bit too steep, I think, from the expectation about US yields. in that time. So overall, the Trump trade is a bit too fast in this direction. We expect, for example, for TI to trade at $60 end of the year, but to show some weakness during the next weeks.
Back to where we started on the oil price. We were talking earlier on with Alberto Gallo from Algebris. We were talking about how the shale producers put this cap on the price. He said, yes, it could get up to 60, but then it kind of can't go much higher than that because of the shale producers. Is that the type of ballpark number you're thinking about for oil?
Yeah, well, we think $60 to end of next year is fundamental solid analytics of the markets, combining OECD inventories, US inventories, as well as supply-demand trends. 2 weeks ago, when we did this analysis, the average of the analysts have been a bit lower, also the term structure been a bit lower. And what we see now is this overshooting about OPEC. We've seen this overshooting in September as well after the decision making in Algiers. So we expect that oil prices coming down a little bit and then starting to moving up basically in the second half of next year.
OK, Torsten, thank you very much for your thoughts this morning. Thanks for joining us. Torsten Denin, Chief Strategist at Tiberius Asset Management.